So before we start with the steps, let's understand that the monetary policy has changed to a large extent post the recession of 2008. However, let's understand the way the monetary policy used to work before we understand what the changes are in the new monetary policy and the most recent changes since 2008. When we discuss the various steps that the Federal Reserve Bank takes, we need to keep in mind that even though the policy objectives have changed slightly, or that the Federal Reserve Bank has increased its transparency and other changes, we need to understand the way the Federal Reserve Bank did conduct its monetary policy so that we have some kind of context for understanding the new monetary policy. Now, as we've mentioned, that the objective for the Federal Reserve Bank was to first establish the economic targets for the money multiplier M. For that, the Federal Reserve Board needed to identify the linkages between the targets, which could be growth measured by the gross domestic product, or inflation or interest rates, and the money supply. So if the Federal Reserve Board could prove that there was some correlation or some linkage between the economic targets and the money supply, it would have a strong case to influence the money supply in order to influence the target. Therefore, identifying linkages between targets such as real or nominal gross domestic product, inflation, interest rates, and the growth rate of M1, M2, M3 was key. The central bank could then calculate reserve levels that would be consistent with achieving these growth rates. Let's see how that is achieved in more detail by the Fed. So the first step was therefore defining the target growth rate for real GDP with an acceptable inflation rate to determine the target growth rate of nominal GDP. From the results of the FOMC March 15th, 2017 meeting, we see that the target ranges for real GDP inflation as measured by the personal consumption expenditures, unemployment rate, and the federal funds rate. Now, these projections are based on changes of the value from the fourth quarter of the prior year to the value in that year. Now, the long-term median value for change in real GDP growth seems to be around 2%. The long-term inflation target is also around 2%. And therefore, the targeted rate of nominal GDP growth rate would be 4%. The next step would be for the central bank to compare the historical rate of GDP with the historical growth rate of some money stock to find a correlation between the two. This relationship is also known as the velocity of money. As we have seen before, studies by monetarists and the Fed have shown that the nominal GDP grows at roughly the same growth rate of money. Now, theoretically, to target a growth rate of 4%, which is the target growth rate of the Fed, the Federal Reserve Bank would therefore target a growth rate in the money supply by 4%. The Federal Reserve Bank then established a range for M1, M2, or M3 growth rates, depending on which aggregate the Fed decided to target. For example, in the early 90s, the Federal Reserve Bank would have a target band for M2 at 2.5% to 6.5%, and for M3 at 1% to 5%. Now, the Federal Reserve Bank began reporting data on deposits and currency as early as the 1940s. However, it introduced M1, M2, and M3 in 1971. The Full Employment and Balanced Growth Act of 1978, popularly known as the Humphrey-Hawkins Act, required the Fed to set one-year targets for money supply growth twice a year. Now, this relationship between M1 and economic measures started decoupling with the introduction of the now accounts. Despite the M1 growth exceeding the target range the US experienced a terrible recession. The Federal Reserve Bank then stopped announcing target ranges for M1 in 1987. In the early 1990s, due to a period of low interest rates and banking innovations, depositors started shifting from the usual savings and times deposit to stock and money market mutual fund accounts that are not included in either M1 or M2. So in 1993, according to the most popular Federal Reserve chairman in history, Alan Greenspan, in his congressional testimony, remarked that the historical relationships between money and income and between money and the price level have largely broken down, depriving the aggregates of much of their usefulness as guides to policy. At least for the time being, M2 has been downgraded as a reliable indicator of financial conditions in the economy, and no single variable has yet been identified to take its place. So in 2000, the Humphrey-Hawkins Act expired and the Fed announced it was discontinuing its policy for setting money aggregate targets. The use of M2 was then limited to being added in the LEI, or Index of Leading Economic Indicators. In 2006, the Federal Reserve Bank stopped the publication of the M3 aggregate. So if the relationship between money and growth has broken down according to the Fed, what exactly does the Fed target now? We see that with this breakdown in the relationship between M2 and gross domestic product, the objectives of the Federal Reserve Board have changed slightly. If we look at the latest objectives of the Federal Reserve Board, we see that the objectives as specified by Congress are maximum employment, stable prices, and moderate long-term interest rates. So this is the economic factor that the Federal Reserve Bank wishes to influence using its Fed fund rate by influencing the federal funds rate, which is the interest rate, short-term interest rate. While these objectives remain almost constant, over the years, the tools and approach to implementing the policy have changed. Now, in order to achieve these targets of stable prices and moderate long-term interest rates, the Federal Reserve Board now sets the target for the Fed funds rate. So we see in 2017, the median target for December projection is 1.4%. And the range is 0.9 to 2.1%. So the Federal Reserve Bank, once it defines its targets for its monetary policy, its goals and targets for its monetary policy, it would then need to determine how it plans to go about achieving these targets for growth, inflation, interest rates, and employment. And therefore, it would need to determine, as the next step, it would need to determine the volume of reserves necessary to achieve the Fed funds target range, since that would be the primary tool by which the Federal Reserve Bank wishes to influence long-term and short-term interest rates, thereby controlling the behavior or influencing the behavior of households and firms in the funds market, households, firms, and foreign investors in the funds market.